Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. Thanks for having me back every week. I appreciate it.
Oh, absolutely. I enjoy it. I always learn something. It's so much fun talking to you. You have a depth of knowledge and experience where I can only pretend to look. So it's a lot of fun for me to learn from you. So thank you so much. So
Absolutely. Happy to share.
what I wanted to talk about here is foreign investors. Now you have a track record and a history with raising money from Japan. But I just want to talk kind of all foreign investors. I think what you're seeing today is a strong dollar. Obviously, the 10-year note is getting interesting. I think it's at 4.16. The 2 years at 4.5 something.
Wow.
And just last week on the Daily Financial News, I talked about foreign capital coming to U.S. shores. Something like 28 billion came in July, but 172 billion came in August. It feels like foreign investors, foreign capital is becoming to the U.S. because we're the cleanest dirty shirt. We're the strongest economy in a pretty weak world. But what does this mean also for real estate? I mean, we for a long time in residential property saw the Chinese coming in. That obviously stopped with the pandemic. But could we see a lot of foreign capital coming to our shores given what's going on today?
Well, yeah, this is a little bit counterintuitive to me, and I was sort of surprised to learn about this phenomenon because also I think that some of the Japanese investors act differently from the European investors too. But one of the things that is an interesting phenomenon is that when the euro declines against the dollar, more people invest from Europe into the dollar, which is a little counterintuitive. I would think they would go the other way around, because if you're looking at the dollar, maybe what they're thinking is they're trying to get in. They're thinking that the rise is going to continue, so they're going to continue to make money. So what you saw the last time the euro collapsed against the dollar was a big influx of money from Europe into the U.S., which obviously a lot of that goes to real estate because that's what people understand. That's what people feel is the safest. And part of this is sort of, it's the hot money that moves around the world, and people they're worried about the situation in Europe, so they want to jump into America, which they feel is safer. Then you see these flows working this way, and it goes into real estate disproportionately. A lot of it goes into bonds, but a lot of it goes into real estate, and it tends to go into the same kinds of real estate, right? Which is, and I think it's even more concentrated now. A lot of it used to go into office in places like New York and Los Angeles and like the
class A stuff, right? Yeah,
class A or a high class B, office. Now the office market, as you know, has been decimated, right? So it's a lot of it's going into multifamily, right? So, and it used to flood into multifamily and sort of like the big six markets. I think you still see that, but I think you're seeing a lot more money probably going into Texas as well. Now Texas is on all the foreign investors' radars, right? Yeah. So I think that is going to somewhat ameliorate some of the softness of the market that we've been talking about, but it's going to be, again, pretty concentrated into, this isn't like mom and pops bringing their money to the U.S. Right? This is institutional money, so they're going to be investing in institutional grade assets. So you're talking about like your new build Class A, highly amenitized, really blue chip deals that, and probably larger deals too in those markets, rather than your Class C multifamily. It's not going there. It's not going into $10 million deals, right? It's going into your super high end, biggest and best of class assets in the best neighborhoods in those top markets. So it's not going to, Keokuk, Iowa, right? Yeah. It's not going to someplace in upstate New York. It's going to go to Dallas. It's going to go to Austin. It's going to go to New York City. It's going to go to Miami. It's going to go to Los Angeles, San Francisco, Silicon Valley, places like that. So that's what we're going to see.
I think we see some of that in residential as well. Again, just historically speaking, like Miami, kind of South America, money coming to Miami or Florida. You have, Southern California being very popular with the Chinese. New York, always popular. I think what you're going to see in a lot of markets, and again, it'll be, I don't know, the top 10, top 15, 20 markets. When foreign capital gets scared, they come here. And I don't see that changing. I think you saw that in just the huge record-setting treasuries bought in August. 172 billion was a record. So I think we're already seeing signs that really rest of world's in a recession. We may be heading there. I think most people think we are. But this is just going to be a very interesting time. And now we have treasuries. I mean, for the first time, Jonathan, I don't know about you, but the first time I've actually considered buying treasuries, right? I'm like 4.5%. I mean, shoot, why not?
Well, listen, I mean, why would you not, right?
Yeah, exactly.
At those prices, especially compared to, like where the real estate market has been with cap rates, right?
Yeah,
I mean, if you can
what-
get,
I mean,
like, if you
yeah,
can get a guaranteed 4% as opposed to like a projected 4% if everything goes right on your deal,
yeah. Why
like,
wouldn't you?
why
Exactly.
wouldn't you? And then the great thing about treasuries is that they're liquid, so you can sell, as soon as the real estate market changes, you can just sell out of that position and go back to real estate, right? So, and I think that that's going to put a lot of pressure on real estate pricing too, because
I
now,
agree.
for the first time in a long time, we have a risk-free rate of return that's meaningful. We have not had
Absolutely.
this for
Yes.
years, right? And you are old enough, and I'm old enough to know, like, when you learned finance, right? When you learned like underwriting, you're always comparing everything to the risk-free rate of return, and you had
Yeah.
to have a risk premium on
Yes.
top of the risk-free rate of return before you were
Of
going to
course.
invest. And there's like a whole generation of investors who
You just don't know.
I've never even heard this concept before, because the interest rates, treasuries were
We're
zero, right?
zero.
And the
Yeah.
savings account was zero. They didn't, I wonder what was being taught, if they still even taught it in business school, or if they just were saying
Just
like,
glossed
yeah,
over it.
or like, yeah, well, the risk-free rate of return is zero, so just go invest in anything.
Yeah,
right?
skip that chapter.
Yeah. So, but now this is a real thing again. And
Yeah,
again, I think this is good. I think this
I
is,
do too.
I think this is good for the economy, right? It's good for savings. It's good for people who are on fixed incomes. It's good for
Yes.
anybody who ever wants to retire in their life. Like, and people who work hard for the money and want to put it someplace safe and actually make a return on it. This is a good thing, and it's going to suck out a lot of the bad money chasing bad deals, or hot money chasing bad deals, and going up that risk, ladder, as we've seen with the chase for yield, right? I mean, this is going to introduce some discipline back into investing, and thank goodness for that. But it's going to be painful, and everybody's going to grumble about it, and it's going to cause all kinds of dislocation. But I think we've gone way too long without, we haven't paid the piper a little bit for a long time, so now we're gonna have to pay the piper a lot. And
we're going to pay with interest, as I like to say. So yeah, this is a fun conversation. I think the risk-free rate of return, was zero for too long. Yeah, and seriously, buying a 1 year or 2 year, but maybe doing a ladder, are things that I'm seriously considering at this point. So Jonathan, where can people find you?
So you can join my free Facebook group and join the conversation over there. That's the multifamily investment community. Just search for it on Facebook, and there's a couple questions that you need to answer when you join. Happy to see you there. You can Google Two Bridges Asset Management, and you'll see my investor page. You can sign right up on the investor page if you want to get on my list. And if you want to get on my general list, you can go to apartmentinvestorsclub.com, and there's a free download there for you. And you'll get on my list and get my newsletter, notifications about my podcast, notifications about my events, that kind of stuff. So please join up.
Awesome. Thank you so much.